I'd like to welcome everybody here to part 2 of our 4-part series focusing on ASC 606, the revenue recognition. So briefly, we're going to go through some introductions. I'll provide you with a NetSuite overview, and then we're going to be talking to KPMG's partner, Prasadh Cadambi, and his expertise with regards to revenue recognition, and then we'll open it up to some Q&A at the end to cover off on any questions that you may have. So our presenters today are myself, Tom Kelly. Just briefly about me, I have been a CFO of both large and small companies. I have been a user of NetSuite for back in the days when it was called NetLedger, and now somehow I'm part of the product marketing team. So excited to do it. My focus is primarily on the financials and all the good stuff, and specifically with this key topic that we're going to be talking about today, ASC 606. And momentarily, I will get into some more details about Prasadh and his background with KPMG. So just at a high level, a little bit about NetSuite, the #1 cloud ERP. We like to think we were the first cloud company. Today, we have over 5,500 employees around the globe. There are over 40,000 organizations and subsidiaries globally that run on NetSuite. And towards the end of 2016, we had achieved a $1 billion revenue run rate. We have over 13 offices. We have several offices in 13 countries. And I'm sure that many of you are aware, in November of 2016, the acquisition of NetSuite by Oracle was completed for a total of $9.3 billion. And today, we serve as a global business unit of Oracle, focused independently on the NetSuite offering, servicing our clients, and providing the best possible ERP experience that's a cloud-based ERP for anybody. So what does NetSuite do? At a very high level, in a nutshell, we're prepared to run a business, but there's certain, obviously, aspects that have to go with running a business. There's the platform that we're built on. It's a multi-tenant platform. It's built on an Oracle stack, but it's a unified data model. What does that mean? It means we are on one database. So the ability for an organization to get insights at the highest level and down to the transaction level exists very simplistically through pointing and clicking and drilling down. We also provide omni-channel e-commerce experience in addition to our ERP, our services platform, and CRM. And the point to make here is that probably the analogy I could give everybody is when you think about omni-channel, think about Amazon Prime. What we are able to do at NetSuite is we're able to primarily provide the experience for companies large and small, end-to-end, from an omni-channel shopping experience all the way through the financials and obviously revenue recognition, which we'll be talking about here today. OneWorld is our offering that provides a consolidated capability for organizations that are multi-subsidiary. The offering is multi-book. It's also multi-language, so it's provided in various languages throughout the world. Multi-currency, and also importantly is multi-currency tax compliance, which, as we all know, tends to ebb and flow and grow as with each day. And then another thing that we also focuses on is being able to provide industry focus and verticals. Our key focus in these verticals is software, services, A&P, nonprofit manufacturing, wholesale and distribution, as well as retail. Our pillars are fourfold. We have one unified system, which I mentioned. Everything is on one platform. The ability to point and click to drill down across the entire organization, the entire system. It's quick, it's efficient, and it's designed to do so built on the internet platform. And primarily, we are built to run a business. And there's obviously many components to running a business, but what's key here is that we're able to provide it on one platform across the entity. So it's not just one department. And this also includes the omni-channel e-commerce capability as well as billing. And we are global and a verticalized ERP. We can provide rich core global financials with deep industry capabilities, as I mentioned before, in terms of the areas that we focus on. So one of the, at a very high level today, there's really a 5-step roadmap for revenue recognition. Step 1, we want to identify the customer, the contract with that customer. From there, we identify the performance obligations that are embedded in the contract. Step 3 is to determine the transaction price. Step 4, we want to allocate that transaction price to the performance obligations. And then finally, step 5, recognize revenue when the performance obligation is met or satisfied. So a little bit about Prasadh. Prasadh serves as a lead partner overseeing and managing global audit teams for KPMG. In addition, he advises some of the world's leading software and cloud companies to help them implement new business models and transformation programs, complex transactions, M&A, and capital raising transactions. Prasadh was in KPMG's national office and was responsible for writing interpretive guidance, development of thought leadership publications, helping clients and engagement teams resolve complex accounting issues, and teaching technical accounting topics at training events and webcasts. Prasadh also served as a national office liaison for certain KPMG clients. What's interesting about Prasadh is he did spend 2 years as a practice fellow at the Financial Accounting Standards Board, FASB, specializing in revenue recognition matters, and it led to the development of the new accounting standards, which involved actively working with preparers, equity analysts, regulators, and auditors. So with that, would like to start out with our first question and ask Prasadh. Prasadh, first, welcome and thank you for taking the time to do this. We value your expertise and your time. First question we have is, what is the background behind ASC 606, and how is it different from previous revenue accounting rule changes?
Yeah, thanks, Tom. Thanks, Tom. In terms of ASC 606, it is different than some of the historical revenue standards. Historically, the FASB took on this project. I've been living, breathing 606 for more than 8 years. I can't believe it. It's going to be a decade on this project. It's a global revenue standard. It was a convergence effort between FASB and ISB. So it is a global standard, and also it impacts various industries. So what's different is historically when we had rulemaking in the U.S., it was generally industry-driven and industry practice-driven. If you think about our 97.2 rules or even the aerospace and defense rules, so it was generally led by the industry groups and it was developed by the industry. So there was no gotcha or surprises in those standard setting. There might be 1 or 2 for other guys, but generally the whole industry there is not significant. But the new standard is much more broader and it comprises of all the industries. So you might have a knock-on effect. You might think that if you have your head down and think, hey, this is my current practice and this is our current policy, hey, this, and try to rationalize it, that's what I call it, under the new set of rules, sometimes you might be in trouble. You will have to take a clean sheet of paper and look at the new rules and what is your business facts, and then how do you comply as per those new rules. So that's how I kind of put it, like why these new rules are significantly different than historical, I would say, standard setting, and this is an important standard given its revenue recognition.
Okay, thank you. All right, let's talk about some of the, in the context of your FASB experience and, the current efforts you're doing. So you said you spent 8 years working on this. I guess we're soon to feel your pain. But as far as adopting 606, can you give us an overview of the requirements for revenue and expense accounting under 606 and kind of the operational impacts it's going to have for organizations?
Yeah, so in terms of the high-level impact, I'm going to kind of highlight in the software world, there was this notion on VSOV, that is vendor-specific objective evidence, and if you didn't have VSOV, all the revenue was deferred, and it was easy to structure contracts to get to a ratable model or to get like a different accounting outcome if you didn't have VSOV. So it was historically kind of contract-based, and do you have VSOV or not, and your accounting was driven based on that. Under 606, it is driven based more on your business facts and circumstances, and the revenue recognition depends on what is the value of the goods and services that you're delivering to the customer. And that's a big change. So you would need to think about truly, what am I giving the customer? What did the customer buy? And what should be the value of those goods and services? So you're going to estimate my standalone selling price for those goods and services. Some of the more complex areas under the new standards for revenue is technology is kind of evolving. As I mentioned, this rulemaking started many years ago, and today technology is moving at a lightning speed. You have all these hybrid cloud models. When I call about hybrid cloud models is where you have software on your computer, but you also have some applications on the cloud, and both work on and off together like Microsoft 365 and others. So when you have those kind of scenarios, it is a little bit more thinking involved on what is truly the accounting model under this new 606. So if you have like any kind of business models that is kind of cutting edge, you would need to really think about what's your facts and circumstances, how do you fit in the principle, as opposed to the old rules you would use to think about, hey, do you have ESOV or not? If you're in the software world, and then your accounting conclusion was easy. Now you have to really think about how involved am I selling one solution. Some of the ways of thinking about it is my on-prem, is my hybrid cloud offering, is it a transformative in nature? If it is transformative in nature, then you might get like similar to a SaaS-based, like an over-time revenue recognition model. So the other thing which people often get surprised by the revenue recognition standard is, even though it's the revenue recognition standard, it also deals with expenses. So the standard basically requires you to capitalize sales commission costs if the expected benefit from the sales commission is you're going to derive over a longer period of time. When I mentioned that benefit over a longer period of time is generally, I was in Philadelphia, it's a completely different industry group. Even in that industry group, you basically pay sales commission on a new logo. So say, for example, the new sales commission, you pay a sales guy on a new logo at a 20% of your sales contract. That gets capitalized under the new standard, even though your contract could be just 6 months or 12 months. But if you don't make any renewal, the same contract gets renewed by the customer, you don't make any renewal sales commission. That means the benefit what you paid the sales guy is to acquire this customer, so the standard requires you to amortize the sales commission, capitalize and amortize over a longer period. So that has an immediate P&L impact benefit because of capitalizing of sales commission. So these are some kind of like a high level, if you ask me, to think about revenue. It's not a rule-based, what is the value you're providing the customer. And in essence, the core principle of the standard is you recognize revenue that depicts the value that you're transferring to your customer. In essence, what are the goods and services you're providing to the customer, and what is the estimated standalone selling price of those goods and services you're delivering to your customer. And for sales commission, it's capitalizing, and what's the benefit of the expense, what you're incurring.
Just a couple follow-ups on this one. So with VSOE, I had heard you mention in other conversations that it essentially is going away under 606. Is that a correct statement?
Yeah, the VSOE concept is gone, but under 606, in terms of 606 has this concept about estimating selling price, but it does give you, like, I would say, like a two-step approach on the, like, non-software contracts, non-software transactions, and the current GAAP, you have this guidance on multiple elements, and that gives you a three-step approach. Do you have VSOE? Do you have third-party evidence? And then you estimate your selling price. And in 606, you have a two-prong approach. Do you have observable selling prices? And if you don't have observable selling prices, then, okay, go ahead and estimate. And observable selling price under 606 is not as rigid as VSOE. The threshold to have VSOE was pretty high, but you can easily have an observable selling price.
Okay, very good. All right, so I guess now it's time to ask the audience. We have our first polling question. And so what we'd like to know is, what company type are you? Are you a public company? Are you currently a private company but targeting an IPO in the next 12 to 24 months? Or are you a private company? So I kind of feel like it's the guy who wants to be a millionaire. So you'll please take the time to cast your votes and help me out here. That would be great. All right. So it looks like we're getting some results here. So we have, in terms of the folks who casted their vote, about 30% of the organizations on the call today are public. 8% are targeting an IPO in the next year or two. And 62% of those on the call are privately held companies currently. Thank you, folks, for taking the time to do that. We appreciate it. So let's move on to the next question, Prasadh. And with public company adoption of 606, we know it's going to be 2018 as a requirement with an option for 2017. But what does this mean for a private company that is thinking about going public this year or next?
So if you're a public company, if you're a public company, calendar year-end company, it was effective from Jan 1, 2018. And for private companies, you have extra one more year, and that will be January 1, 2019, if you're a private company. The standard, if you're going public and if you have ECG, Emerging Growth Company status, then you do have the private company rules apply for you, and you do have this extra 1 year. So it will be applicable for you from Jan 1, 2019. And the standard does allow for different transition approaches for method of adoption. So the method of adoption would be you can either do the full retrospective, that is generally for a public company, you present 3 years of income statement and 2 years of balance sheet. So that means you're going to recast your numbers for 2016 and 2017 because once you're up in Jan 1, 2018, that is you're looking at all your open contracts as of Jan 1, 2016. And any difference between the new GAAP and old GAAP gets recognized in your stockholders' equity statement. That's one method. The other method you do is like a modified kind of retrospective method that you do that analysis as of Jan 1, 2018. And any difference between all your open contracts between new and old, you recognize in stockholders' equities. So for a private company, you generally have this method of transitions. So the one thing to think about is if you're a software company or if your business models are drastically changing in terms of how you recognize revenue, you have this extra year. Your bankers might be asking you that, hey, I would need a full retrospective method because if you're going public this year and you're going to, or you go public in 2018 and you're going to adopt the new standard in 2019 and suddenly your revenue completely changes from the day you went public because of this adoption of new 606. So that's something to think about is what does your banker require? Even though you have this optionality, would you be boxed in from doing this full retrospective method of transition, especially if you're going public in the near future? That's something to think about.
And so you had mentioned that you can put it into stockholders' equity, but when you talk about analysts or even large private companies, can it get a little misleading, if you will, if you're putting it all in stockholders' equity when you probably should be recasting it in your income statement so you can really determine what performance truly is year over year?
Yeah, so what you put in stockholders' equity, Tom, is the difference between the old GAAP and new GAAP. So that's why, so there's a lot of companies kind of think about, especially, say, on the current U.S. GAAP, you have a ratable revenue recognition model, like, say, it's a time-based license. You're recognizing revenue over a 3-year period. Say you sold the contract on December of 2017 for $100 million. And it goes from December of 2017 to, say, December of 2020. But once you're on Jan 1, 2018, you adopt these rules, and your 606 rules might say, hey, you should have recognized revenue, a significant portion of that revenue, say 80 million or something on day one when you actually sold the contract because it's just pure time-based license. So that revenue gets lost in your retained earnings as a catch-up kind of an adjustment because you have nothing to perform. So that's a pretty significant impact. So in some of those cases, I'm seeing some of the large software guys and some of the big impact that they do a full retrospective transition to at least take credit in the back periods to show that, or other people who have been proactively been thinking is to make sure that by the time you adopt, you don't have a significant impact based on what are my open contracts when you go live on Jan 1, 2018. It's something to think about. You still have a few more months to go to see whether is it easy to have as minimum impact. So there are a lot of companies thinking about how much of an impact I'm going to have, like lost revenue. They call it as revenue gone in the black hole, right? Like you don't get credit for this revenue, any kind of cumulative catch-up adjustment, which goes in retained earnings.
That's interesting. So no doubt a lot of effort that's going to need to be put forth to get here. All right. So let's move on to the next one. So, we've been talking a lot about certain types of adoptions and how you're going to account for certain aspects and how you do restatements. But what are so many areas where you think that the most judgment of interpretation will be necessary? In other words, those ones that, I guess, even from an auditor's perspective, an analyst's perspective, that it's going to be scrutinized how companies judge how they're going to do, these restatements.
Yeah, that's a good point. Definitely, this standard requires a lot more judgment than under current U.S. GAAP current rules. So if I kind of think about a lot more judgments, you'll have to make judgments in terms of like as simple as collectibility, right? On a current U.S. GAAP, there's this notion called cash basis accounting model. What I mean by cash basis accounting model is, say, I am a U.S. company, I sell a product to a customer in China or some developing country, and I don't know who that person is, so I'm going to recognize revenue as cash comes through the door. And not try to assess when I actually deliver the product, what's the value of the product. The new standard takes away this cash basis kind of accounting, and you'll first need to go through this screening process on, do you even have a contract? And collectibility is one of the criteria to even have a contract. If you do have a contract, then it asks you to go and do an estimation based on your historical practice, what that is, and recognize revenue. And even if you're going to collect 50 cents on a dollar, you would estimate that and recognize revenue when you deliver the product to the customer on 50 cents on the dollar. Another thing I can think about where there's a lot more going to be estimation is when, say, a company offers like coupons or incentives. Like if I can boil it down to simple senses, say I sell cars through the dealers, and every year I always have run a promo for Thanksgiving or during Christmas season. I always run a promo to the dealership, and I always have like a certain rate I offer incentives during running these promos during these holiday seasons. On the current U.S. GAAP, say if you sell a product but you haven't announced this promotion yet, there is no accounting for that promotion until the offer has been made. Under the new GAAP, based on this past practice, if there is an expectation that, hey, you always run a promo, so any cars or any products you sell out of the door, you would need to estimate much promotion or incentives you're going to give to the customer. So that's another estimation. And then another thing I can think about at a high level, this would be significant from some of the software and the technology companies space is royalty reporting. So when I talk about royalty reporting, what I mean by that is under current U.S. GAAP, you sell a product, and every time your customer sells a product which has your technology in it, they kind of report how much royalties they owe to the company. And say the customer sold products from October to December, and they report to us in January or February. When the royalty report comes in, the company recognizes revenue in January or February for my customer sales of these products from October to December. Under 606, the interpretation which the SEC staff has made a couple of speeches on 606 on this topic is the U.S. securities regulator is basically that, hey, you cannot do this lag-based reporting under this new 606 rules. You will have to accrue revenue estimate for October to December sales what your customer made and recognize revenue during that period from October to December, because you recognize royalty or usage-based royalty fee as those underlying sales happen. So that process itself would be a significant systems and process and estimation methodology. And when you think about on the cost side, when I talked about like capitalization of sales commission, there's some estimation involved in that capitalization of sales commission in terms of over what period I need to amortize my capitalized sales commission. Is it 3 years, 5 years, 7 years? So there's a lot of data that needs to be gathered, what that period should be, and what is my amortization period. So that itself is going to be some lot of exercise on that.
So it's almost like, it's kind of equated to almost when you're accruing for, payables at the end of the year, you're going to need to have some type of system and visibility in terms of what your, whether it's a partner channel, whatever you want to call it, how they're going about their sales, so that, when we talk about judgment, you've got the ability to, provide evidence as to, the rationale behind your accrual. And then from, you and your team's perspective, that would be something that would lend itself to, easily to be reviewed and understood for both parties. Would that be correct?
Yeah, that's right. It's like you would need to accrue, not wait for your customer to actually report what happened and recognize revenue when the customer reports. So recognizing revenue when your customer reporting versus you have to estimate how much did your customer sell from October to December and accrue revenue at the end of December. So that's this royalty. That's the significant effort you will need to think about, and depends on how many customers you have, and that could be a significant process. There's a lot of estimation involved.
Okay, interesting. Okay, let's move on to our next polling question. And question is, to what degree do you think audit fees will increase as a result of adopting ASC 606? Do you think they'll increase to a large degree, greater than 50%? Do you think it's going to have a moderate impact on your audit budget? That's kind of a range of 15 to 49%. Do you think it will have a minimal impact, which would be, pretty much 0 to 14, or do you think it will have no impact at all? So if you wouldn't mind, if you could please cast your votes so we can get some perspective on what the mindset is of the over 350 participants that we have on our call right now. All right, so the feedback that we're getting right now is about 50% of the group thinks that there's going to be a moderate impact in terms of the cost of the audit. 14% are indicating it's going to be a large impact. About 31% is indicating that it will be a minimum impact to the organization, and 4% of the group thinks that there will be no impact at all to their budget with regards to what 606 will impact in terms of their audit fees. So that's interesting. Okay.
That's an interesting polling question, Tom. I didn't realize you guys had this. It's a good information for us. The one thing I kind of highlight, I kind of mention, I know you don't have this question over here, but I want to highlight to our is there is a significant effort involved in terms of the disclosures, and I don't know whether you have a question for me on disclosures. I can wait till then, or if not, I can handle it now, Tom.
Yeah, probably what I guess what the group or myself and everyone would like to know is when we talk about the disclosures, or what is it that you're going to look for that, can one expedite the aspect of 606 in the audit, or what are some of the, pitfalls you want to try to avoid to make sure that, the process goes smoothly between the organization and its auditors?
Yeah, so in terms of disclosures, the 606 has very, very incremental, significant disclosure requirements. And one of the disclosure requirements I keep highlighting to folks is there's a backlog disclosure requirement under 606, and not all companies provide this backlog. And as auditors, we have to sign off on this backlog numbers for on a quarterly basis if it's a public company. And it's not only signing off on the backlog number, that is your committed contracts. And again, 606 has some complicated thinking process on even what is the definition of the term of my contract. Do you have month-to-month contract, or is it a 12-month contract? So 606 kind of defines what is my contract term. So there's thinking around people to think about what is my contract term, and then what is my transaction price, and that's again 606 definition. And 606 requires you, as part of disclosure, not only disclose the backlog number, give me future rollout in time bands, how revenue is going to be recognized. So, and the future revenue to be recognized, that analysis should be under 606, how revenue is going to be recognized. So as an auditor, you're not only going to sign off on the numbers, the historical financial information, but you need to sign off on the numbers for the future rollout of all my open contracts and the accounting as per 606. And the requirement is only for contracts that are 12 months and above under 606, this disclosure requirement. But what I'm hearing is from a lot of C-level execs is they rather disclose all contracts, because otherwise that number might look like a low number if you don't have a 12-month contract, because once if you're a public company, that disclosure becomes an investor focus area. What I'm hearing is more and more companies want to disclose even contracts that are not 12 months long, even short duration contracts as part of the disclosure requirement. So that itself is a pretty different mindset thinking from a process and then audit perspective.
I would agree. So the next question might be a little bit along the same lines we just discussed, but how far along are most companies, and what are they doing to start to evaluate the impact of 606? And maybe in this case, not necessarily as we talked about in terms of what you have to set up, but just the impact it's going to have on the organization itself and its people, the financials, the resources. What is your perspective on that, and what should companies be preparing themselves for?
Yeah, so I would, my education process has always been the companies like, hey, think about establish it'll be as simple as project governance, right? And some of the steps are basic, like who should be part of your 606 project team. And it needs to include people from your sales, legal, finance. It shouldn't just be an accounting-driven project. And it could be as simple as your meeting minutes cadence, issues log, how are we going to share our files on SharePoint site, what is my project timeline. Even those basic steps are important. And when do you loop in your auditors? And if you're a multinational organization, in fact, now we are dealing with some of the large companies for us to go and train people in a lot of the local jurisdictions. So it's not only your accounting under your consolidated basis, but there is a different, like this is what I call, like every country has a different accent, right? Like you speak in a different accent, I speak in a different accent. So 606 is going to have a different accent in each local gap. So what is the interpretation under local gaps? And that interpretation might be different than your US SEC gap. So there is So thinking about my statutory reporting for my local jurisdictions to produce financials and training my people as the contracts come in. So that is a pretty significant effort. And in terms of the sales organization, I'll kind of give you why it is important to include sales. I'll kind of share this example. Most of the time I kind of give this example because it kind of highlights the importance of it, including sales. So the simple example is, say you have a 3-year contract and the year one ACV is $1 million, year 2 ACV is $2 million, year 3 is $3 million. The sales guys will generally get paid on the year one booking of $1 million. Say it's 10% is the sales commission rate, so $100,000 gets paid on year one. And year 2, the contract branches up to $2 million, so there's an incremental $1 million pickup. And the sales guy will get paid incremental $100,000 in sales commission in year 2, same way in year 3. Some companies would have a gotcha in the sense of a long-term retention strategy for the sales guy to say that, hey, you would get paid the sales commission year 2 and year 3 only if you remain employed with the company at the end of year 1 and the end of year 2. If you're not with us, you're not going to get paid the sales commission. So that itself on the 606 is going to create confusion in terms of the 606 would say, hey, that doesn't seem to be just like a sales commission on booking a contract, but also seems to be a long-term retention strategy incentive, so you don't get to capitalize that sales commission. Not only that, if my contract is just, so you might have to change your contract by saying that, hey, I would pay the sales commission if I reassign the account to a new sales guy, he might get paid to it because no matter what, cash goes out of the door. So that you're trying to change your business practice. Not only that, on the 606, if your contract, I call this as ramp contract, if your contract ramping is purely a discount driven for like a payment term driven, in the sense the customer is not getting like incremental seats every year, like 10,000, 20,000, 30,000 seats, you would be recognizing revenue $2 million each year instead of $1 million, $2 million, $3 million in year 3. So that itself is you would need to think about, hey, do I want to change my sales commission strategy? And what happens is in this situation is since revenue for each year is $2 million, $2 million, $2 million, from a GAAP reporting purpose, there is no incremental revenue in year 2 and year 3. So do you want to pay a sales guy on ACV basis, which is based on the contract, or do you want to incentivize your sales guy based on how your financial performance is doing? So that is like an overall philosophy. Each company thinks about it differently. So that's why I kind of highlight in terms of thinking, if it's just not an accounting exercise, you would need to think about broader in terms of how do you do business, what's your sales impact, and also your investor communications.
Yeah, so I mean, it definitely is going to seem that you're going to have to make sure this is a cross-functional exercise where everybody's walking in each other's shoes, because it obviously there are many dimensions that we're talking about here. Let me just go on to the next question. And maybe on this one, it is somewhat redundant, but maybe let's just focus it on the aspect of controls or internal controls, right? So we've talked about processes. You've mentioned about some of the impacts with some good examples about what this is going to entail for organizations. But we talk about internal controls. Do you see any like key internal controls that most companies will have to consider implementing or changing?
Yeah. So in terms of implementing it, before I address that comment on additional controls and process, let me give an example. So this is a new accounting standard, right? It's completely new, and it's a significant new accounting standard. And it is very significant. So in terms of from an internal controls perspective, if a company gets a deficiency on adoption of a new accounting standard, not a deficiency or a material weakness, generally people would say it is prudent to figure out whether that deficiency on adoption of a new standard has been remediated. And say a company does get a material weakness on adoption of new accounting standard, your auditor might say, hey, it might be prudent for you and me, since you got a material weakness on the adoption of a new revenue standard, you're going to be adopting the new lease standard. That's also an adoption of a new accounting standard, and the new lease standard goes into effect for public companies on Jan 1, 2019. So the companies might have to remediate in another new adoption of a new accounting standard that they don't have a problem. And I think an adoption of a new accounting standard, a deficiency could arise from misapplication of a gap, or you didn't, that there is no data process to capture the data for adoption of a new accounting standard. And generally, I think people might distinguish between adoption versus a continuous ongoing effect. An adoption would be like on day one adoption would be on Jan 1, 2018. When you adopt and your auditors come in January 2018 and audit this and find problems, they might raise those comments. So my suggestion has always been that, hey, we should do a dress rehearsal, right? Like when you do a dress rehearsal in, say, 2017, you have your auditors come and do if you're heavily enterprise contract driven, have like your auditors review on the current gap and the new gap in 2017, because the auditors are not required to evaluate or audit adoption of a new standard in 2017. So any problems they identify in 2017 would just be a discussion point. It won't even raise to a level of deficiency, so that you have all this dress rehearsal and you kind of do the pseudo closing the books of your opening balance sheet, say as of end of September or end of June, like whenever, based on your plans, and make sure that everything is teed up so that when you go live on Jan 1, 2018, there are no surprises on both sides. Because that would be, if you're too late in the process and have your auditors kind of scrambling when you file your Q1 2018 10Q, I would strongly recommend that to make sure that the company and the auditors are aligned in testing controls and signing off, even though the auditors are not required to sign off on controls as part of your quarterly filing. Since it's an adoption of a new standard, to make sure that those controls are tested, process and controls on adoption of a new standard is tested as part of Q1, especially for a public company, mainly because you don't want your auditors coming in at the year end when you file your 10K saying that, hey, we found you didn't adopt the standard correctly and you have a big problem. It goes back to your Q1 10Q and adoption impact. So that would be my suggestions for a public company to do a dress rehearsal. And for a private company, you might have a lot more leeway, because anyway, you might not have to apply the internal controls framework in Sarbanes-Oxley. So there will be a lot of more wiggle room for a private company in terms of controls, but especially for public companies, this topic becomes more critical.
Okay. Very good. All right, so let's go to our final polling question. And so question is, are you concerned that your current systems will hinder the adoption of 606? Yes, no, or you're not sure. So if you would, please cast your votes so we get some perspective on what the mindset is relative to the systems that you're using currently today to operate the business, report information, etc. Yeah, let me wait for the results. And it's kind of even. So 24% of you feel that your current systems are going to impact to some degree your adoption of 606. 36% feel that no, your systems will adequately be able to handle the adoption of 606. And 38% of you have indicated that you're not sure. So so that's an interesting perspective. So kind of across the board, about 1/3 each. But getting back to the last question now, Prasadh, and maybe on this one, maybe we just focus on it. You've kind of talked a little bit about this, but are there any specific, audit testing examples you can provide that might be a little bit, different per se than how audits have been performed to date, particularly with the perspective on 606?
Yeah, when it comes to this topic, what I kind of highly recommend to this group is to reach out to your auditors and they are going to be using, like, we have something called the diagnostic tool, which has like more than 175 questions, and that we kind of evaluate for each revenue stream to figure out, did you consider every single aspect as part of the 606, and did you consider every single fact pattern to make sure is it complete, is it accurate as part of your assessment? I would encourage to get hold of how your auditor is going to go about it so that you're not missing some steps or processes as you go about your evaluation, so that your evaluation, the company's evaluation is complete and there are no gotchas when your auditor comes in to check that, hey, you forgot this and these are the topics. So that'll be one thing. And the biggest issue, the topic I kind of highlight to people is, think about knowledge assessment. People who are processing orders under 606, do you have people adequately trained on 606? This webinar is a great from that sense. And think about maybe customized company-specific training of your people who are going to process these orders under 606, because under existing REP rules, people live and breathe it for a long time, and that education on 606 you might have to do to your, not only for your revenue team, but also your sales guys, and also for exec management on what are the new rules are, and are they qualified enough? And some companies, what I'm hearing is the head of revenue is going to keep a test for his people. So your auditors might be looking at, in terms of how we go about testing, is what is the tone at the top of the company? Are they taking 606 pretty seriously? That's based on the SEC staff speech. Is the company taking 606 seriously? Do you have adequate systems in place? Do you have systems in place to track your backlog information? Do you have systems in place to track your disclosure requirements? And when it comes to disclosure requirements, the standard requires you to disaggregate revenue. So in those angles, we might be looking at, how does management talk to investors for a public company? And a company getting ready to go public, the disaggregation of revenue might be based on, what is it going to be in the S1 document? How are we going to talk to the investors? So it is about your systems and process to capture the completeness of those data, and is the data accurate? Do you have enough adequate systems to cover that? And the one thing your auditor is going to be looking at is, which is the biggest pitfall I see, is there's a difference between a process versus a control. A process is someone who's doing it, and that's your process, how you prepare your information, but your auditor is going to come and ask you, what is the control? A control is who somebody is reviewing that information, is to make sure is it correct, is it true and accurate, right? So we would need to think about, from a company's process point of view, like, okay, you have a great process to put together all this information under 606, and it's a great project team, but who's going to be reviewing that information, like whoever is preparing, is that control operating effectively? That's one thing to think about from company's perspective, how your auditors are going to be looking at in auditing and testing 606 of the standard.
Well, good. I appreciate that insight, Prasadh. I think that should help out a lot of the organizations here that are a little bit confused. So, reach out to the auditors. We've got about 7 minutes here to go, and so why don't we do this? Why don't we open it up to any questions that the audience may have for Prasadh relative to 606 and what you're currently experiencing within your organizations. All right. There are some questions today, just that probably more administrative, asking about the slides of the presentation. Yes, we will make them available. You will probably receive an email with a link to where you can download the slides, so absolutely. One question we have here is regards commissions. And the question is the suggestion that amortizing the capitalized commissions over the customer's life, or is it estimated to be longer than the contract term?
Yes, it is generally if your new logo commission is say a 10% rate and renewal is at 0, then your amortization period is going to be longer than the contract because you have to factor in what is my anticipated renewals I'm going to get from this customer. So it will be longer. But if your commission on your new booking and your renewal booking is you pay the same commission at 10% rate or almost close to each other, then your amortization would be same as your contract period. But generally in practice, I don't see not too many people. It might be an exception to the rule that people are paying sales commission at the same rate of a new booking versus a renewal business.
Okay. Another quick question here is is this going to impact not-for-profit organizations as well?
If you fall under the not-for-profit exception under GAAP, then you apply the not-for-profit exception, special accounting under GAAP. But if you don't fall under that, the 606 is a default accounting standard. The one thing I would highlight is even though it's called revenue recognition standard for 606, 606 also addresses derecognition of a non-financial asset gains or losses. The only thing you don't apply for when I call it derecognition of non-financial assets is when you sell a fixed asset, when you sell a building, when you recognize gain or loss on those sales, you have to apply 606 on when do you recognize the gain and what is the transaction price. The only thing that does not apply in 606 is the disclosure requirements do not apply in those cases. So as you can see, the extent of applicability of 606 is really broad.
Okay. Here's a question. So from a 606 standpoint, can private companies adopt it early? I mean, is there any rationale that would say, no, you shouldn't, or you should?
So I think the earliest you can do is the initial adoption timeline to early adopt. You won't be able to early adopt sooner than that. So initially the adoption date was for public companies, for calendar year public companies was Jan 1, 2017. And for private company was Jan 1, 2018. So you can earliest you can adopt is that time period before the extension was applied.
Okay. There was a question about is it be able to define what observable selling price means?
Yeah, so an observable selling price, I can give you an example. This was when I was at the FASB as a staff leading this project with the FASB board members. We had a bunch of telecommunication companies, AT&T, T-Mobile, and Sprint. In a sense, the question was, hey, I don't have standalone sales of my handsets. I don't sell my handsets on a standalone basis, so I don't have observable price. I always sell my cell phones with a contract. So one of the board members asked these guys a question, hey, what happens if I break my cell phone? I have to walk in and buy a new cell phone, and I have to pay full price on this iPhone, which is like $650 or $700 for the iPhone. They said, yeah, we do have some standalone sales. And the board members like, hey, what is the percentage of time you've had this distressed sale of a handset? And the response was, hey, we've sold it like 10% of our time, 9% of our time. And that number equates to there are 300 million cell phone contracts in the U.S., and out of which 10% is a pretty big number. The board member said, yeah, you do have an observable price because you do have standalone sales. So it is not like a VSOE threshold to think about, but you would need to think about how much transactions you have. Is it too little or not, or is it a good indication of what my pricing pattern is or my selling price is? the cell phone example might be easy because there's a lot of hard cost involved because I buy the cell phone from Apple or Samsung, but if you have a soft cost like software, it might be a little bit more challenging.
Okay. All right, with that, we're coming up on the top of the hour here, so we're going to close this out. Prasadh, I want to thank you very much for taking the time and providing us with your insights and your expertise on 606. I do want to let the audience know that as far as being able to get the recording and the slides, yes, they will be available, and you will receive that communication shortly. But as I mentioned, this is part 2 of a 4-part series that we're doing here at NetSuite on revenue recognition. And so part 3, we will be holding a session on April 3rd. And on this one, we're going to be looking at Wall Street's take on ASC 606. And then finally, for part 4, which will be done on April 19th, we're going to provide you a NetSuite demo, and we're going to literally show you how NetSuite can, to some degree, make, I'm sure Prasadh won't agree with this, but make accounting for ASC 606 as easy as fixed asset depreciation. So I'll have to prove that to you, Prasadh, but I think we can do it.
That's awesome, Tom. Like the one thing I would say we are at the top of the hour, because I do get pulled into systems implementation. So a lot of people ask me, hey, do we need to do a bolt-on RevRec system, or do we stick to our ERP solution? My only advice to companies has been, if you have too many systems, it's going to be problematic. So even if you have a bolt-on solution, that's not going to be an end-state solution. The end-state solution should be everything in an ERP system. So that's what I'm not paid to talk by NetSuite on that. That's my philosophy. And it's my view is your end-state solution should be your ERP. Bolt-on solution, it's probably a temporary fix in my mind.
And I would have to say I'm in agreement with that, Prasadh. All right. So, hey, everybody, thank you very much for taking the time out of your busy schedule to listen in. Hope to see you on parts 3 and 4 of our revenue recognition series. And with that, everybody have a wonderful day and good accounting to you all. Take care.